Hello everyone, Douglas here, Cantor Market Analysis. It's Friday, October 19th, 2018, 10:30 p.m. Eastern Standard Time. And this evening, we are going to be taking a look at a handful of charts, keeping it pretty much on the Elliott wave side for this update. And I know I have a kind of Q&A or question that I want to dive into more. So I'm going to save that for the next macro update, either on Sunday night or Monday at some time. There was a question regarding kind of the interplay between markets, savings, and interest rates and that sort of thing. And I really want to dive into that because I really think it's probably one of the more important things, if not the most important thing to understand in terms of how markets are really driven higher. So I want to make sure and explain that and give the time that it deserves. Anyway, let's get going then with the charts. You can see the lineup here on the screen that we're going to take a look at. And yeah, we'll just kind of jump on into things. So let's move on into to the S&P here, right out of the gate, and then just kind of a reminder of where we're at long term. Likely the completion of some sort of primary wave 3 in one degree or another. That's still what we're thinking. Just the question is this going to be an expanding flat pattern, or will we have a deeper primary wave 4 it ends up in its own kind of 3-wave counter trend pattern of itself. At the end of the day, they both will, regardless of what turns out, they'll both be very similar in total kind of makeup, if you will, with the still possible chance of another push higher, but unlikely at this point. So we'll wait and see for that one. Let's see. Let me make this kind of comment to kick things off, and I gotta say, if I were to be writing a script for kind of my 1987 hypothesis, this is exactly how I'd be writing it. Everything's really unfolding exactly as you would expect if we're going to get a really deep sell-off here. We'll take a look at 10-year yield and bonds in a few minutes, but they continue to push higher, and stocks are just unable to catch. Not to say that it's definitely going to happen, but the probability seems to be increasing higher and higher, so thus the TVIX and the aggression for the downside. Let's see. Let's zoom in now to well, the first thing I want to point out too on the daily chart here is just the subtle close beneath the 200-day moving average again. So I don't think we've had two closing days in a row, or not that these are in a row, but this close together below the 200-day moving average in quite a long time. Nothing back during that sell-off in the earlier in the year. Let me see. Yeah, we never finished twice below, even during the election, or I'm sorry, the Brexit sell-off. The last time we had it was during the 2015-2016 sell-off. So technically speaking, a lot of damage being done in the S&P. I know the Dow is not quite there in terms of being on a 200-day, but we're starting to see more and more happen in that sense. So the reason this is important to follow the 200-day moving average is the momentum trade is grown in popularity over the last decade, along with risk parity. And all momentum or the momentum trade is effectively just being above or below the 200-day moving average. And this has been one of those things like risk parity, like risk premium within risk parity regarding interest rates. The momentum trade is also a kind of an algorithmic trade as well. So there's forced selling when momentum shifts, and I forget the name of the exact model that keeps momentum into it, or essentially equates or has a factor. It's one of those like multi-factor models that has momentum as an important factor. So we want to keep that in mind. And it's it is actually a good tool. Momentum trading is a good long term. I mean, it has shown a lot of promise long term, which is why I go ahead and keep those 200-day moving averages on there. Anyway, all that aside, it's important to keep in mind that we are breaking down, and technical traders have used the 200-day moving average for a long time as well. So let's move into the 4-hour chart here, see what we're seeing, and this is going to be kind of the theme. Just kind of moving forward. Still got my marks from the last little chart update. Same idea still, really. There's still a chance we pop higher, a little bit higher, and carve out a little bit more deeper to the upside zigzag pattern. But I'm still feeling pretty confident that we're going to find resistance if we do pop at the 2870 level and push down. However, at this point, I'm definitely leaning towards selling sooner than later. And again, this is a theme I'm talking about, even from a kind of longer term perspective, unable to hold higher prices, even today, unable to hold higher prices. So just not looking terribly promising here. If selling picks up now Monday into Tuesday, and we're able to break below probably, let's say 2740 at the lower end of this consolidation, I'm closing out my longs in the S&P and pretty much just being short at that point. Maybe I'll just close out the NASDAQ side and keep the S&P for a little bit of a hedge. And that hedge has been working really well as we'll look at emerging markets and Eurozone in a minute. But the hedge has been working pretty well. Maybe 1% or 2% we've gained doing this. So it's kept us safe and it's kept us not having to overtrade this right now and kind of worry about these pops. But I do think if we break down too much more here, I think selling will likely pick up, and that'll be kind of the trigger we need to just go nice heavy short here. But that's really what I'm seeing is just an inability to kind of do any counter trend rally whatsoever. The one thing that will worry me, and I'll mention this on each chart as well, is we will be having some RSI divergence here. It's one of those things where I guess I would expect it, obviously, because of the major sell-off. But if we do get back in the oversold category, I'm not going to read too much into it until we see a big completion. So that's kind of how I'm reading things. Because one possibility, if we were to make a deeper low, is that this is some sort of 1 very deep 2, 3, 4, 5, and then push up. So again, that would be kind of future stuff. And if we do catch, let's say we do push down here and we just really start to consolidate and nothing happens, then we'll see, what to make from there. But at this point, I don't really see that playing out, or at least still the highest probability, I think, is some heavy selling moving forward. But we will play it safely. You can get really caught up in a lot of choppy trading here if you're not smart. All right, let's move into the NASDAQ. And again, that same look, right? Just completely unable. I know a few of you play candlesticks, and those upper wicks are just ugly looking. And that is usually what pops out the most at me from a candlestick pattern. The inability to hold any sort of buying whatsoever just looks nasty. So same idea with the NASDAQ here. I mean, a breakdown of a longer term trend line, and I think selling just picks up from there. And so, yeah, we'll just keep a close eye on it. Let me switch to the daily chart, because okay, we did break the 200-day the other day, but we're not back underneath, but very close. So even the NASDAQ, which has had a heck of a ride up over the last year or so, is once again kind of meeting its match at the 200-day moving average. Next up is the Russell, and it just continues to take a pounding. And again, with the Russell, that RSI divergence, but if we push any lower, it will likely kind of invalidate itself once we go into oversold territory again. But I really don't have too much to add to the Russell here. It just looks terrible. I wish we had a little bit better pop up or consolidation for some sort of even wave 2 of something down here, right? So some sort of 1, 2. But that would be my one hesitation to this whole thing, is that we're not kind of the pump's not primed, if you will, for that next big wave in selling, but it doesn't have to happen either, if that makes sense. So that's just kind of, I guess that's just kind of where I'm at right now. That I think the probability is high enough that I'm willing to be short, net short overall. All right, let's move on to emerging markets here. And what I really like, now here's what I really like about this is just as we were kind of looking for and expected, we bounced right off the back test of the broken long-term trend. And this really definitely kind of added to the overall boost in confidence here with regard to the sell-off hypothesis, if you will, as we did bounce right off resistance as we should have. And we made an attempt today to get higher, and we just didn't. Selling after the open, so looking good all around. So my guess is likely a 2 wave right here. this likely completed one, or maybe some sort of running flat pattern. And running flat patterns are really bearish. So if that is what is the case, then we're looking at some heavy selling going forward. All right, moving on to the Eurozone. Same concept, just unable to hold any selling here. And again, and I guess I should have said this in emerging markets. Yeah, we haven't made a new low yet, but if and when we do, we'll get some RSI divergence. Again, I mean, if we bounce, we bounce, and yeah, I mean, we'll play it when it happens, I guess. But it's not too far. I guess the thing is, I just want it on your radar. Keep it. Yeah, just keep an eye on it. And if we do get a bounce, I mean, it could set up for a heavy bounce. I'm just not seeing anything on the macro side yet that seems to indicate that we're going to get any sort of heavy bounce. So like the Chinese growth numbers came out, GDP number came out a day ago, 2 days ago, and it was just bad, which was expected. And so, China has a big hand in global inflation. And unless China turns around and says, hey, we're going to really, try and reinflate this, I just don't see it happening. So, yeah, so that would be kind of the macro case for a bounce here. And maybe that's what the chart is saying, that we're going to get that, but I'm not buying it yet. Yeah, again, Eurozone, EZU, again, definitely some RSI divergence, but yeah, same story there. Nothing more to add there. All right, let's move on from the equity side of things and take a peek at the dollar. Very nice rally, just like I kind of was looking for, right off the 50%. Actually, a very big rally over the past couple days. So looking very good. Fits right in with our wave 2 count. So yeah, we'll likely get some consolidation around the 96 handle here as we push up, and then maybe some resistance as we push to the highs that were put in back in August. But other than that, looking very looking very strong, very bullish here. And kind of exactly what you'd expect. So yeah, just going to look for a little bit longer consolidation, and then finally the next big push up moving forward. So let's move on to bonds here. And yeah, bonds playing out really as expected as well. We were kind of looking for one more higher high here to fit in that RSI divergence and start to get the rollover, which it looks like we might be getting. And this is really what I think is setting up to be the big pressure point, if you will. Make sure you watch those risk parity videos when I talked about that. But as bonds push higher, this just resets the whole thing, and yeah, the pain could get bad. Keep an eye on bonds too, because I'll switch to TLT now. Keep an eye on bonds too, because this might be my next play going forward from here. I really think, especially if we get a big sell-off, as we're expecting, I really think the Fed is going to have to come out and say, look, this is just a little bit worse than we thought globally, and we domestically, and we need to pay attention to it and accommodate it. And so I think we could get some sort of bounce here in bonds. So yeah, I'd love to see one more lower low here in TLT, and then maybe I play some sort of TLT in 10-year, what it was, IEF or whatever, the 7 to 10 year as well. See if we can get that change. But to have a real change, we need the Federal Reserve to come out and say we're really going to accommodate global slowness. Otherwise, if they were to come out and just say, no, we're going to continue to push rates higher no matter what the effect is or what the cause is to markets, then I'd probably just stay out of bonds altogether. I'm actually going to jump to gold next, because I want to tie in my point on gold with bonds here, right? Remember the real rate thing with gold. Make sure you watch that gold video if you haven't. It'll explain the real rates. And this, I'm really quite amazed with gold's resiliency here, with rates continuing to push up and possibly making a new high, and the dollar pushing up as well with gold where it's at. And really what I think is happening with gold here is I just don't think gold is buying the global narrative, or at least is buying the Fed's narrative. And I think gold is kind of tipping its hand that the markets just don't believe that rates are going to continue to push higher. And that, in other words, it's really just a hedge on a big bounce in bonds here moving forward. And I think what's being signified is that the Fed is ultimately going to get behind inflation. That's kind of what the market is saying. And so if that's the case, then then I think we could see a bounce in gold here momentarily, if you will. So if you're a big gold bug and this is something you really like to play, I mean, I think there is kind of a case to be made that we're going to see another leg up in gold. I don't know if I'm going to play it or not. I just there's just too much risk in it for me. I don't know. Maybe I will. I mean, yeah, I think there's a case. Let's just put it that way. So especially if you're in an environment where you don't have the most liquid of assets, I think gold makes an okay play at this point going forward from here. So let's switch over to oil real quick. And yeah, kind of as expected, downward pressure. We got the EIA numbers in. And yeah, nothing happening here too much in oil. So I think in the meantime, I think we're likely heading back down to at least that 64 range where there's support, if not down to the 60 range to carve out some sort of B wave here or something like this before we move for a next leg up from here. So that's what I'm keeping an eye on. Nothing I want to short. There's a lot better shorting opportunities, but nothing that that I'm going to be playing. But we do need to keep it on the radar one way or another, and then we'll go from there. All right, finishing off with natural gas, and this will be a YouTube post that we'll cross post on the YouTube channel with NatGas, but kind of came back on my radar. One of the guys that I follow very, very closely is Art Berman, and I'm going to put on his website real quick. He is my go-to guy when it comes to all things energy, and I was just reading his recent report on natural gas. And pretty much his conclusion is, if I scroll all the way down here, that it's unlikely there's going to be a major shortage, but a normal winter will lead to a short-term price spikes in local markets. History suggests that prices could reach $4 to $4.25. So with that in mind, and it's worth a read. And look, there is no one who is better at what they do in their distinct discipline than Art Berman is with energy. I highly recommend him. I mean, he's just great with his insights, and he's the one who really turned me on to oil back when we were all the way down at 40. So I take what he says very seriously. Actually, we were in the 30s, and he was really calling for a big run. And so, and he does a great job of explaining everything. So I mean, just have him on your watch list, add him on Twitter, try and understand what he's doing, because he's really good at what he does. So anyway, he's looking for a slightly stronger winter here. And with that in mind, that kind of fits with this overall count right here, some sort of ABC pattern breaking out. The longer term count is just a very long-term complex combination pattern that I think will ultimately finish lower in the long run here as we go past, say 2020 or something like that. That fits with the kind of global deflationary nature that I think is eventually going to hit in the not too distant future. But in the meantime, it does look like we might have some sort of impulsive for an A, B, and then push up for a C. In terms of actually playing this or not, I don't know if I'll play it. We'll see. I do kind of like the pattern here. I do like the breakout. I do kind of like the roundness here, but I just don't know if it's worth the risk reward overall. Maybe I might. Maybe I could see it kind of fitting in with an overall construction here, and it could be a good hedge. I mean, the one thing that I do like about this, it could be a good hedge, kind of on the inflation side of things. So I could see that as a possibility. So I'll keep it in. I'll keep it on the watch list. I'll keep it on the radar, and possibly make a play, kind of depending on how things play out with equities. The one thing is, if we do get a sell-off in equities, things just might be happening too fast to really kind of construct a portfolio position with this. So we'll see, and see how it unfolds. I do kind of like it, though, I must admit. But just at least wanted to get that onto your guys' radars as well. So and kind of on your watch list. So if it is something that interests you, you got an Elliott count to go along with it, and some good macro research to read up on. If you like the NatGas play. All right, that is it. And like I said, hopefully Sunday or Monday we'll have a post up that's a little bit more macro oriented. In the meantime, have a great weekend, good trading, and we'll see you next time. Bye bye.